Good afternoon, ladies and gentlemen. I'd like to welcome you all to the Halftime Talk feature interview series. I'm delighted today to be joined by Mr. Joseph McMonigle, Secretary General of the International Energy Forum. Mr. McMonigle, thank you so much for joining us today to get your insights really on the year ahead for what I'm sure will be a very interesting market.
Well, it's great to be back, and as you say, there's a lot going on in energy markets, and of course, geopolitically. So a lot of ground to cover, I guess.
Absolutely, and we'll cover as much of that as we can over the next half an hour. Thank you. Let's start with what was a bit of a story really last year as well, before we get into today's events, if you like, and that's the forecast for demand for oil, energy demand. We could argue that last year, we had the opposite of what the majority were expecting in terms of what came from China, how the US economy performed, etc. Are we any better placed this year to forecast demand for oil? And give us your take also on this divergence that we've seen develop between the different agencies on forecasting.
Yeah, so I think certainly there's a macro narrative that was very uncertain, I think, for most of 2023 that definitely impacts, how is the world economy going to grow? Also in certain parts of the world like China, what's going to happen there? And also in places like China, Asia, too, which is a big growth engine of demand. And so I think this idea, is it going to be a soft landing, a hard landing, or no landing? That plays, a big headwind, I think, on the narrative of demand. I think we've seen physical markets, though, quite tight for most of 2023, with the exception of the fourth quarter, because we had really unexpected growth in supply from non-OPEC, mainly the US and also Iran. So the shortfall that I think was forecast for the fourth quarter, because of those reasons, didn't come to fruition. In terms of the divergence in the monthly forecasts, I mean, I think a lot comes down to really uncertainty over the energy transition. And by that, I mean, every year the IEF hosts, co-hosts with OPEC and IEA. It's part of our trilateral working arrangement that the IEF facilitates throughout the year. We hold a series of events with OPEC and IEA, and the flagship event is the Outlook Symposium, which we'll host later this month here in Riyadh. And essentially, one of the big takeaways the last 3 years has been basically we take all the different energy energy transition scenarios for oil demand in 2050, and we put it on a chart, and the IEA has several scenarios, OPEC has several, ARENA, and then you throw in different company scenarios as well, and think tanks. And essentially what you have is the difference between the highest demand for oil in 2050 and the scenario with the lowest demand for oil in 2050 is about 100 million barrels a day. So that's the size of today's oil market, give or take. And so that creates tremendous uncertainty. If you're a policymaker that needs to make decisions about roadmaps, if you're a company CEO or board member that needs to make decisions on investment issues. So it creates a lot of uncertainty. And of course, for modelers, it also creates a lot of uncertainty. The IEA is definitely forecasting, I think, greater energy efficiency gains and also greater penetration and use of EVs than OPEC is. But just to start with 2024, OPEC is predicting double or forecasting double energy demand growth in 2024 than IEA is, and so we'll have to see who's right this year. But a lot of it, I think, the root cause is really this uncertainty about the energy transition.
Yeah, and of course that will take its shape and form, and is being influenced by various things, including capex. Obviously, we'll talk a bit about that later on conventional versus cleaner energy. But let's just take that last point that you made about the difference in forecast. OPEC is still forecasting better demand just for the year ahead. Let's look a bit more short term, and yet it is the group that is cutting the supply, isn't it? And many saying that it's going to have to really hold tight to those cuts for the first half this year, given demand expectations. But so let's talk a bit about that, about how you think it can manage that role going forward, given you mentioned increased US production that we saw in the fourth quarter. Is it going to be a bit more difficult task for OPEC to manage that this year?
Well, I think OPEC is really making decisions to accommodate for this extra non-OPEC supply that's hitting the market, and so as a result, I think we could see, basically the policy announced, for cuts through June of this year, to probably continue. I think we'll have to wait and see what the data shows in June. One thing I've learned is that, and I think some people just think OPEC is going to do certain things based on where they want prices to be. And what I've learned is really they really want to see the data, and so therefore they're not going to respond to data in this quarter or next quarter. They're going to look at data closer to the meeting, both current data and also what that would mean for forecasted data for the rest of the year. So I think they're going to remain flexible for the June meeting. But I think, just from our standpoint, looking at 2024, I think we're probably going to see adequately supplied markets, and probably more supply coming on board this year due to the US and Guyana and Brazil. Amazing things happening in Brazil thanks to the leadership at Petrobras. And so 2024, I think we're going to still be in a fully supplied market. I'm worried about 2025 though, because I think that's when we can start to see supplies start to, or the growth start to oil supply growth start to be reduced, and of course I think demand is going to continue to be robust. So I think 2024 I think is a little bit of a transition year.
Mm-hmm. And I mean, just sticking to the US production that we did see kind of have a bit of a blip by all intents and purposes last year, it surprised most people, didn't it? But going forward now, it's being told it'll keep increasing incrementally, but maybe at a slower pace. But why was that a surprise? What was it that kind of threw people off a little bit in the fourth quarter?
Yeah, well, I think first of all, the price point I think is encouraging investment in the current range, the $70 to $80 range, and also, I think they're just getting massive efficiency gains. Utilizing new technology, lateral drilling technology, but also AI and other tools that are really helping them, surprise. One of the things I've learned with shale, both on the upside and the downside, is it always surprises. And so we're still seeing surprises, I think, from the shale sector in the U.S. 2024, I think, is forecast to slow growth. But again, I think if we do see a surprise, it'll be on the upside.
Okay, and just let me ask you then a bit about, let's stick to this about non-OPEC versus OPEC plus supply for now. We've talked about how OPEC will probably look at the market going forward and what it's likely to do, and read the data, etc. One announcement we got from Riyadh in the last week was on Aramco's intentions to increase its capacity to 13 million and actually not continue with that for the time being. in terms of increasing capacity 13. Do you think what's triggered that? Is it that they have other expenses that they would rather spend on, or is it that they actually believe that we're going to see, peak oil sooner rather than later, as some people would say?
Well, I'll leave that to Aramco and to the Saudi ministry to tell you what's behind that. But I do think, I will say this, I think it's a mistake for people to read in some kind of change in Saudi Arabia or Aramco's view on long-term oil demand. I don't think that's what's driving this decision. And if you look at other things going on in the market, Saudi Arabia decided, in the last year or so to basically take oil that's currently being used for power production in the country for domestic reasons and replace it with renewables and natural gas. And so that will free up by 2030 another 1 million barrels a day to be exported. So there are other things going on, I think, that probably are part of the calculation in a decision like that. But look, I'll leave it to Aramco and the ministry to tell you more about that.
Okay, fair enough. Let's talk a bit about what's happening in the geopolitical sphere. We could talk about Russia and Ukraine, but let me ask you: do you think the market has settled into some kind of comfortable space, if you like, in terms of how that conflict is impacting flows, direction, etc.? Any concerns there going forward, or have we got 2 years of a pretty permanent pattern now?
Well, I mean, I think the Ukraine Russia situation is more a Europe specific issue and more on natural gas. It hasn't really had that big of an impact on oil markets, and there's been some trade flows that have shifted, but for the most part, it hasn't turned out to be a big of a problem for markets in terms of impacting physical supplies in a global market. But on the gas side, I think it still poses a real threat to energy security in Europe. Europe, really depended on LNG exports from the U.S. To help them get through last winter. They've been able to build inventories, I think, because the weather, I think, has cooperated. But I don't think we're out of the woods this winter, and I think for the several years to come, we're going to have issues regarding the natural gas outlook in Europe. And by the way, I might just point out too, the situation in Ukraine and Russia has kind of exacerbated, I think, what was already an energy crisis in Europe. Remember, before the war in Ukraine even started, we were seeing sky-high natural gas prices in Europe and parts of Asia, and that was really due to a lack of investment in natural gas upstream. And so, it's something that at the IEF we focus on investment in upstream, both in oil and gas, because we're worried about number one, the impact on consumers. We focus on producer-consumer issues, but also on the energy transition itself. And if the public starts to equate high prices and volatility with the transition or climate policies, we're in big trouble. So we have to be very careful and manage the transition, and that means keeping an eye on investment in upstream and capex.
Okay, and I mean, on the LNG front, in terms of capex and sort of new FID, if you like, coming online, we know what's sort of in the pipeline already. But so, how vulnerable? LNG market at the moment is pretty well priced, plenty of supply for current demand, if you like. But where do you see that critical inflection point perhaps hitting due to the lack of capex in LNG and gas specifically?
Well, I mean, it's certainly a couple years ahead, because I think a lot of the world is looking at natural gas not just to be a bridge fuel, but to be a critical part of their energy transition plans. And so the demand for natural gas is going to increase. And so I think we are going to see, if we go on the if we stay on this recent course of limiting investment in upstream, we are going to see high prices in natural gas as well, and that's not good for energy security purposes. It's not good for the energy transition itself, because I think it undermines public support for the transition.
Okay, and Mr. McMonigle, let's go back to the geopolitics and talk a bit about this region where I am and where you are in the Gulf, Red Sea specifically, and obviously the heightened alerts, if you like, in that area over the last month, starting with the Houthi attacks on some shipping, and now we have a response from the US and the UK to an extent, and yet oil prices remain very comfortably in the same range that we've seen them in for the last 3 months, really. So what's going on there?
Yeah, I mean, I look at current prices. I don't know where the price is today. I haven't looked at it, but in the high 70s for Brent, there's no risk premium built into that. I mean, you've seen global inventories below the 5-year average. In the U.S., the inventories have fell consistently the last 3 weeks. And, the macro output that we talked about at the beginning of the show, it's probably the strongest it's ever been in terms of positive outlook in the last 2 years. So you have all that going for you, and the price is really just 77. So you could argue that that's even too low a price for those conditions that we just outlined in the oil market. But now you throw in, geopolitics and geopolitical risk. I don't think there's any risk built into the current price. And look, I think, global energy security risk is at an all-time high, and particularly because of the issues involved in the Middle East and in the Gulf region. And I think we're descending into, it's a very fragile situation. I think that could really trigger an energy crisis that we haven't seen since the first Gulf War 30 years ago. Currently, we've seen some impact on shipping, but it's more, I think, resulted in a shipping premium, but it hasn't really impacted physical supplies. But if you're looking to cause havoc in the global economy, energy infrastructure, I think, is a very attractive target. And I'm just really concerned about this and worried that we could be sleepwalking into a big geopolitical crisis here with regard to energy assets and energy infrastructure. And so I think we have to be very vigilant. I know the countries in this region are, quite concerned about it, and obviously these are key assets for them, and they're deploying a lot of resources to make sure that everything is safe. But I just think the market is very sort of too comfortable with the current situation, and I'm very concerned that the situation seems to be escalating with regard to energy risk and energy security than de-escalating. And so we're going to keep an eye on it, and certainly urge everybody to monitor it as well.
Okay, and how much influence do you think, and just stepping aside from geopolitics for a minute, going back to the macro outlook, soft landing, hard landing, US, etc. But let's talk a little bit about US Fed policy and how that obviously trickles through not only to capex and things like that, and appetite for that, but also to the sentiment, and how that impacts just generally demand sentiment in the year ahead. Does the market, do you think, does the energy market feel it has a clearer indicator from the central bank monetary policy side on, what could happen with interest rates and how those things obviously might impact expenditure and demand. We're looking at slightly more stable year ahead, aren't we, in that sense?
Yeah, I think so. I mean, I guess I would say, again, going back to the macro outlook that we talked about at the beginning, which I think for most of 2023 really weighed on markets. In fact, I would say that in 2023 we really had a tale of two markets, because you had on the equity side, you had a lot of positive outlook in terms of the global economy for at least the soft landing and no hard landing, and therefore the equity markets really grew in 2023. But in the oil markets and commodities really in general, you had very tight markets, but the market did not really, price points did not really respond to that reality. So I think to the extent that the Fed is signaling that the concerns about inflation are subsiding this year, and that we will go back to a more positive outlook for 2024, I think bodes well for demand. And the IMF recently upgraded its forecast for global growth, so that's another, I think, good sign. And so again, I think 2024 is a bit of a transition year because of the Fed decisions, because of in the energy space and the oil market, I think because of non-OPEC supply. But I think that's going to change in 2025. I think we're going to start to see really the trends start to matter a lot.
Okay, and of course, I'd like to just touch on China, because that's obviously a huge consumer, and could impact how 2025 looks if we're looking at a tighter market. But of course, we've seen the Chinese story, relatively okay growth last year, again expecting about 5% this year. By all intents and purposes, a good rate for a large economy. But there are just negative headlines coming out of China all the time, aren't there, in terms of general direction going forward. How nervous should energy markets be about that in terms of security of demand going forward?
Yeah, I mean, I think this is again, sort of a more micro, if you can refer to micro with China at all, but it's more of a micro tale of two markets again, because yes, you have these negative headwinds and sentiment about, manufacturing data and other, stories related to the real estate sector. But on the oil demand side, we've actually, in 2023, we saw growth between 1.3 to 1.8 million barrels in a year where there was all these negative headlines about Chinese economic growth. So oil demand and energy demand is still growing despite the noise about the greater macro China economic issues. And I think that's going to continue. And it actually, especially if you see some kind of stimulus program, obviously that'll be accelerated and accentuated. So I'm not as worried on the energy side. I'm not as worried about China, because it actually is growing. Maybe it's not growing by the expectations that people expected pre-COVID, but it's definitely growing and is a big part of the energy demand growth globally.
It's also a big part of the energy transition story, isn't it? I mean, huge investments going into EVs, and it's also that a huge supplier, obviously, of renewables equipment, things like solar panels, etc. That has been cited sometimes as another reason to be concerned about its oil demand, if you like, going forward. I mean, is that being taken seriously? That China's serious about moving ahead quite quickly on that front?
Well, China is such a huge country that yes, they're doing tremendous things on adding renewables. They're the world leader in growing nuclear capacity, but their energy demand is just such a huge number that I think I'm not worried at all about oil and gas demand in China at all in the next several years. I think they're going to continue to do sort of all of the above, at least for the foreseeable future. So I would say, I would agree with you. Yes, they're doing so much on renewables and on the transition. A lot of the technologies are being built there, or the raw materials are coming from China. So they have a key role to play, but I don't really see it impacting oil and gas growth globally.
Okay, and Mr. McMonigle, just to touch on the capex question again, let me just get your view on. We looked at sort of what governments might be spending, and NOCs, for example, in this region. We talked about Venezuela, etc., and Brazil. What about IOCs? They've done pretty well in the last year or two on oil prices. Great windfall gains in 2022, if not last year. Do we expect them to be, pushing their capex much more going forward? Some of them have been a bit more reticent about the whole renewables commitment as well. Where do you see that going?
Well, yeah, I think in general, I mean, first of all, during COVID, you saw both IOCs and NOCs, reduce capex because of the uncertainty about COVID. NOCs have really come back. Most NOCs are actually playing catch up, because certainly the big companies like Aramco and ADNOC and others have come back in a big way, but you have other countries that have budget constraints, I think, so they're playing catch up. So I think on the NOC side, you're still seeing very significant investment in capex. On the IOC side, they're playing catch up. I mean, you actually could claim that it's increased dramatically, but it's really because costs have increased, not because it's gone into new drilling or new supply. So inflation and also rising costs, I think, have had a big impact, certainly in 2023 and also in 2022 as well. And so the question is, what happens when those costs come down because of the Fed cutting interest rates and other inflationary pressures, whether that results in real capex investment. We'll have to wait and see. But certainly, as you point out, the companies have done very well, and so I think there's still, in some parts of the world, particularly the U.S., there's this push to return, have a greater return on investment to investors. But I think now they also have additional funds available for capex. And I think the question really that the market is looking for, that really policymakers have to come to grips with, if we want to avoid high oil and gas prices, is, are we going to send a message that it's okay to invest in upstream? I think the companies are looking for that signal. But if we continue that the signal is it's not okay to invest in upstream, then I think these companies are going to have pressures on them, and we're going to see probably slower growth in capex if we continue in that direction. And the world just has to decide, do we want to manage the transition and avoid sky high prices and volatility, and keep progress going on the transition, or in some cases, I think there's the view we need to just reduce supplies so that we can have a bigger impact on emissions. And I think that's counterproductive in the end, because it undermines public support.
And do you think that the COP28 meeting held here in the UAE clarified things on that front for the various stakeholders?
Well, I think it was the most consequential COP meeting we've had probably since the Paris meeting, because for the first time, you really had energy companies at the table, invited, participating, making key commitments on methane abatement, on decarbonization. You had, I think, very significant commitments on tripling renewables, commitments on efficiency, commitments even on nuclear, which at a COP, 2 or 3 years ago would have been unheard of. So I think there were very many positive things to come out of this COP. The other thing I would focus on too is also the commitment to clean energy technology. The UAE has created now a new fund that's going to invest in clean energy technology. There are other countries like the US, like Italy, like Saudi Arabia, that are investing in this clean tech space. And that's important because, we talked about the OPEC and IEA at the beginning of the conversation and the divergence on their outlooks. But the IEA also produces a technology report every year. And the recent report basically says wind and solar and renewables get us to about halfway to meeting our climate goals. The other half has to come from new technologies that are not yet commercialized or not even invented yet. And certainly hydrogen and CCUS and probably things like fusion are in that category. But this is where we need to be investing in the energy transition. I'm not sure the world needs to be, countries need to be deploying, limited budgets in renewables, because there's a lot of private money available for that now,
Mm-hmm.
and a lot of incentives for the private sector in that regard. But what we really need is, or for governments to invest in this clean tech space, because it's, companies are doing it, yes, but we need sort of the scale that governments can provide. Also, some of it's a little bit more riskier for companies to invest in. So really we depend on countries and governments to do this. And so I was very encouraged by what was going on in terms of commitments and investing in clean tech as well at this COP meeting. So there's a lot to follow up on, I'm sure, but a lot of accomplishments.
Joseph McMonigle, Secretary General of the IEF, thank you so much today for joining us and giving us your insights for the year ahead for the energy markets. It's been great to have you.